Most financial advisors tell you to diversify. Put your eggs in different baskets. Spread your risk. Play it safe. Elon Musk did the exact opposite. And today, we're going to break down exactly how his anti-diversification strategy built one of the largest fortunes in human history. Elon Musk's net worth fluctuates, but it's consistently over $200 billion, making him one of the wealthiest people on Earth. But here's what most people don't understand. Elon Musk is famously cash poor. He doesn't have billions sitting in a bank account collecting interest. He doesn't have a vault full of gold bars. His wealth exists almost entirely as equity in the companies he controls. Tesla, SpaceX, and now X. This isn't just a fun fact. It's the foundation of his entire Elon Musk investing strategy. And understanding this difference between net worth and liquidity is crucial if you want to understand how to build wealth at any level. So let's dive into 4 pivotal moments that reveal how Elon Musk's approach to capital allocation changed the game. The PayPal gamble. Let's rewind to 1999. Elon Musk had just sold his first company, Zip2, for about $307 million. His cut? Around $22 million. Not bad for a 20-something entrepreneur. Most people in his position would diversify, buy some real estate, invest in index funds, secure their financial independence, and never worry about money again. Elon Musk took almost all of it and poured $12 million in his next venture, X.com, which would eventually become PayPal. Then, after the dot-com bubble burst and his company nearly went bankrupt multiple times, PayPal was sold to eBay in 2002 for $1.5 billion. Elon's share? About $180 million. Again, most people would diversify at this point. You've proven yourself. You've made generational wealth. Time to protect it, right? Wrong. Elon took $100 million and invested it into SpaceX. Another $70 million went into Tesla, and $10 million into Solar City. This is what financial experts call capital concentration, and it's the opposite of conventional wisdom. Instead of spreading his wealth across dozens of safe investments, Elon went all in on 3 incredibly risky ventures. Companies that, according to most analysts at the time, had almost no chance of success. The lesson here isn't just about risk tolerance. It's about conviction. Elon Musk's investing strategy wasn't diversification. It was concentration on ventures where he believed he could create massive value and, critically, where he had control. The cash flow ecosystem. Now, you might be thinking, okay, but how did he survive? If all his money was locked up in these companies, how did he pay his bills? This is where Elon's approach to capital allocation gets really interesting. Between 2008 and 2010, both SpaceX and Tesla nearly went bankrupt. Elon was so cash-strapped that he had to borrow money from friends to pay his rent.
And difficult at the time. 2008 was probably the toughest year that I've had in my whole career because at SpaceX, we'd had, of our small rocket, the one we started off with, we had 3 failures in a row. And if there'd been a 4th failure, the company would have died. And then simultaneously, the financial markets were going to hell, and we were raising a financing round for Tesla, and the financing round fell apart because people didn't have any money. And I had to basically take all of my remaining cash and invest it in Tesla, and in fact ended up borrowing money just to pay rent.
He's talked about how he was down to his last few $1 million and had to choose which company to save. But here's the strategy most people miss. Elon used leverage. He would borrow against his Tesla shares to get cash. This allowed him to keep his equity in the company while still accessing liquidity when he needed it. He wasn't selling his stake and giving up control. He was using his paper wealth as collateral to access real dollars. This is a sophisticated strategy that wealthy people use all the time. Instead of selling assets and paying capital gains taxes, they borrow against those assets at low interest rates. It's called buy, borrow, die in wealth management circles, and it's a core component of how to build wealth while maintaining control. Elon also created an ecosystem where his companies could support each other. Solar City provided solar panels. Tesla made batteries and electric cars. SpaceX pushed technological boundaries that benefited all his ventures. This wasn't just about financial independence for himself. It was about creating a network of companies that reinforced each other's value. The Twitter/X acquisition. Let's fast forward to 2022, when Elon made headlines for buying Twitter for $44 billion and renaming it X. Here's the question that baffled everyone. How do you buy a company for $44 billion when you don't have $44 billion in cash? The answer reveals everything about how the ultra-wealthy operate differently than the rest of us. First, Elon sold about $15.5 billion worth of Tesla stock, but that still left him short by nearly $30 billion. So what did he do? He used leverage. Massive leverage. He secured loans backed by his remaining Tesla shares. He brought in equity partners and co-investors. He even got the banks financing the deal to provide $13 billion in debt that Twitter itself would be responsible for paying back. Think about that for a second. He bought a company partially with money that the company would have to pay back. That's leverage on leverage. Now, this is where the concept of liquidity becomes critical. Elon Musk's net worth might have been over $200 billion at the time, but that doesn't mean he could write a $44 billion check. His wealth was tied up in equity, shares of Tesla and SpaceX that he couldn't or wouldn't sell all at once without tanking the stock price and losing control. Being rich on paper and having cash to spend are two completely different things. This is the reality for most wealthy people. Their net worth is in assets, real estate, businesses, stocks. To access that wealth, they have to either sell those assets or borrow against them. Elon chose to borrow, maintaining his control while accessing the capital he needed. The Twitter acquisition also shows the risk of this Elon Musk investing strategy. By leveraging so heavily, he put himself in a position where he had to make the company work or risk losing not just Twitter, but potentially destabilizing his other holdings if the debt became unmanageable. The different game. So what can we learn from all this? Elon Musk plays a fundamentally different game than the average investor. The traditional advice, diversify your portfolio, invest in index funds, don't put all your eggs in one basket, is solid advice for preserving wealth and achieving financial independence over time. For most people, this is the right strategy. But Elon's approach to capital allocation isn't about preservation. It's about creation. He's not trying to protect what he has. He's trying to build something that's never existed before. This requires extreme concentration in a few high-conviction bets, control over the companies he invests in, strategic use of leverage to maintain that control while accessing liquidity, an ecosystem approach where investments reinforce each other, a tolerance for risk that most people simply can't stomach. His Elon Musk net worth is a byproduct of this strategy, not the goal itself. Here's the bottom line. You shouldn't bet your entire life savings on one company like Elon did unless you control that company and have deep expertise in the industry. That's not how to build wealth for 99% of people. But you can learn from his principles. 1. To build massive wealth, eventually you have to take calculated risks. Not reckless gambles, but strategic bets where you have an edge. 2. Understand the difference between net worth and liquidity. Paper wealth and cash are not the same thing. 3. If you're going to concentrate your capital, do it in areas where you have knowledge, control, and conviction. 4. Think about capital allocation not just as, where do I put my money, but how can my investments create value and reinforce each other? 5. Financial independence doesn't always mean playing it safe. Sometimes it means taking the risks others won't, so you can create the life others can't. Elon Musk's investing strategy isn't for everyone, but understanding it gives you a blueprint for how extreme wealth is actually created in the modern economy. If you found this breakdown valuable, hit that like button and subscribe for more deep dives into how the ultra-wealthy really operate. Because when you understand the game they're playing, you can start playing your own version of it. Thanks for watching.